is because they're going to just come down and tag you at the spread. And that would be a shame. So it's not necessarily that it's too aggressive, it's that you're going to be caught in the spread. Next question, under record keeping in CD8, the daily limit for the first month was 100 with a monthly limit of 1,000. Then it said at third month, assuming you made profits every month, you can increase the daily limit to 1,500. Is that right, or should it be the 1,500 as the monthly limit? Yeah, that's monthly. Monthly limit up to 1,500. If you go to a daily limit of 1,500, especially with a small account, you can really get into trouble. I tried to draw out a table in this section and just wanted to verify. Also, as a second question, in CD6 when going over demos, when you make a trade, let's say 8-2 ratio, would you still put an upper limit on the 2 trade? You wouldn't, right? So that you could let it go higher if it rode. Well, remember, on CD6, on CD5, I talk about the multiple ways of exiting a trade. Okay, so one way of exiting a trade, let's say you got into a trade somewhere over either here or somewhere over here, where the market's moving up and you're catching that momentum to the upside. And the market pushes up, and let's say you get in above this high, you take your profit right about there, so you take profit on 8, and you let 2 keep going. Well, one method which would be to have a target and say, okay, I'm going to get out at, say, I don't know what I was trying to write there, 2.0500. So that's your target. And you're just going to exit it as long as price reaches that target. The other way, you take your 8 profit here, would be to wait for the market to close underneath this red line. Notice I didn't say just trade below it, but actually close below it. That would keep you in. Another way would be to use a candlestick exit, where you've got an engulfing pattern or a harami pattern with a follow through. You could use the green line. Okay, all of these are going to have different effects. Okay, first of all, let's talk about these a little bit. First of all, if you use a moving average as your exit, it will tend to keep you in if the market is trending. Okay, that's why trend followers, big syndicates, not syndicates, big CTA firms like Dunn Capital, Susquehanna, John Henry, they will use a very simple moving average type of system. And it's because what they try and do is get in on the big trends. They want to get in down here and sell way up here, but they want to do that on a daily chart, where this would be, maybe 600 pips. And then finally, well, actually they would get out, like say somewhere down here. So the market moves up 600 pips, comes down, hits their moving average, so then they're out. So they're willing to take this drawdown right here. Okay, and what you have to realize is that the longer you stay in a position, so you entered right here, look at this, the market comes all the way back down twice to your entry point. So you've got to be willing to sit there and let the market put, we'll say that this is $300 at the peak. Remember I talked about anchoring? This is why this can be so difficult. Because as soon as you anchor to the fact that, hey, this position had $300 in it, if it goes down here to 0 or a negative number, or say you're losing now $40, this difference is where people can get themselves in a bind. And you forget about the fact that, hey, I'm hanging in for the long haul. Now this also ties into money management. It ties into risk management. So what you've got to do is make sure that you understand all of that. Okay, you've got to realize that it's just not a simple decision of saying, well, I'm going to get off at 8-2 ratio because that's the best way to do it. When the market is trending, you're going to find out that the moving averages work better.